Some call ADC stock the younger, better version of Realty Income, the well-known monthly dividend giant. And I can clearly see why. Agree Realty also pays a monthly dividend with an impressive 4.23% dividend yield. One of the reasons investors love this stock. But there is more. Over the past year, ADC has surged 27%, making it a standout performer in the REIT sector. So, is ADC still a buy at today's prices? Let's break it down by analyzing the latest earnings and fundamentals. And stick around until the end, where I will reveal my 3 price targets for the stock. So right off the bat, ADC reported earnings last week, where they beat on revenue by a slim margin. FFO was in line with analysis expectations. Diving into the earnings presentation, we see that ADC is a 10.9 billion retail net lease REIT, with almost 2,400 retail properties in all 50 states. One of the important things on this sheet is the investment grade, which is currently reported at B credit ratings, which is not so bad, but of course we prefer A credit ratings here. Another really important number is the net debt to EBITDA, which is reported at 4.9 times, which is pretty close to my preferred range of 5 to 6.5, also looking pretty good. Taking a peek at the sector breakdown, we see that the biggest sector, grocery stores, represents 9.2% of the total ABR. I prefer a maximum of 10%, so this is looking pretty good. Home improvement is also sitting at 9.2%. Looking at the tenant breakdown, we see that Walmart is the biggest with 6.2%. Again, we prefer a maximum of 10% here. Next to that, we see some big companies, and some are worried for retail companies to go bankrupt. So far, everything seems fine by me, also because of the diversification. Another thing that I really like is the fact that the 2025 investment expectations is much higher than 2024, almost matching 2023 actuals. So we finally see some growth again. And as mentioned in the beginning of this video, people love ADC for its dividend, which I fully understand, an impressive track record that grows at 6% compound annual growth rate in the past decade. For the full year of 2025, it is expected that AFFO will be in a range to $4.26 to $4.3 per share, easily covering the $3 annual dividend. And now that we know a bit more about the company, it is time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analysis every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. ADC is a 7.5 billion market cap company. P/E ratio is not a fair metric to use with REITs, so I'll be using the price to FFO instead. And right now it is sitting at almost 16.8, indicating they are trading around their fair valuation. Later in this video I will show you my 3 price targets for ADC stock, so make sure to watch until the end, because price to FFO is only telling a small part of the full story here. Revenue is at 617 million, and in this graph we see that revenue went up in the long run. It has to be said that for a REIT it is growing really steady and consistent. But let's keep our eye on the latest trend where revenue is going down. Gross margins are increasing over a longer period of time, but it is much lower versus their peak. The profit margin is decreasing and seems to have some trouble, also something to keep our eye on. EPS is looking flat over the years, and I would love to see some increases here, but for a REIT it doesn't look too bad. Analysts expect a low single-digit growth for the EPS in the coming years. It is not looking too exciting. But I get really exciting when I see the revenue expectations, where it is expected to see low double-digit growth on average. Return on assets is sitting at 2.3%, which is a really low number for a REIT. Return on equity is also looking pretty low, and the most important number, return on invested capital, is sitting at only 2%, which is again a low number, even for a REIT. It is slightly higher versus the 5-year average, so that's the positive part here. Current ratio is at 0.78, which is a decent number for a REIT, nothing special to mention here. And right now ADC has 2.7 billion in debt. I prefer companies that can pay down at least a big chunk of their total debt with the total cash. ADC has only 14 million in total cash, so they can't pay down a big chunk of their total debt. This is something that I don't like. So it is very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow is growing really nice and steady over the years, and for a REIT this is really impressive. Shares outstanding are increasing, which is very common for a REIT, since they increase shares to raise capital. But when shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 4.3%, which is a great number. Annual payout is a little over $3, and keep in mind, ADC pays a monthly dividend instead of a quarterly dividend. Payout ratio is at 74%, which is around the 75% average for REITs. The 5-year growth rate is at 6%, which is a decent number, and they increased the dividends for a significantly longer period than the 5 years reported here. In here we see the dividends paid since 2015, and to me this looks really good. ADC really likes to increase the dividends at a low rate, but over a longer period of time this really adds up. And we clearly see they increase the dividend over 10 years in a row. In this graph we see the expected dividends in 2025, 2026 and 2027. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It is expected to grow at the historical rate from here. And overall these dividends look pretty good to me, but how about the historical returns? I decided to compare ADC stock with the overall market, in this case the S&P 500. Next to that I added Realty Income and MMM. On the 5-year chart we see that ADC returned 15%, and this is including dividends. The S&P 500 returned 96%, massively outperforming all stocks in this list. And both MMM and Realty Income are shocking me with a -7 to -9%. On the 1-year chart it looks pretty interesting. We can clearly see the momentum is with ADC, but the S&P 500 still managed to beat the other two REITs. On the 6-month chart, it is the S&P 500 again who is beating everyone in this list. Interestingly enough, ADC was the only REIT to report a positive number here. And on the 1-month chart, it is the S&P 500 again who is the winner. And this time ADC had the lowest return. So bottom line, the S&P 500 was by far the better investment in the past 5 years. And it seems that momentum is a little gone with the REITs. So could this be the perfect time to buy ADC stock? Well, let's check the 3 price targets that are created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets. For the revenue growth I'm filling in 9, 11 and 13%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin I'm filling in 28, 30 and 32. And for the free cash flow margin I'm putting in 70, 71 and 72%. For the PE ratio I'm putting in 20 since it is a REIT. And for the price to free cash flow I'm putting in 12, 13 and 14. My desired annual return is 12.5% since I can get an easy 10% average annual return with owning an ETF. Right now ADC stock is around $71 to $72. I hit analyze and we see a few green numbers. And since this is a REIT, I'm only focusing on the discounted cash flow value. We have a low price target of $68, we have a mid price target of $83 and we have a high price target of $101. To me, the low to mid price target is the most justified here, indicating that this stock could be undervalued. And please let me know the price target that you think is the most justified in the comments down below. My final conclusion on ADC is that I love the business. It is currently in my portfolio and with reason. The company is capable of growing really steady and consistent, and that's really impressive for a REIT, especially in times like this. It also seems that a lot of investors were buying this stock based on the stock price that increased a lot in the past year. Other fundamentals also look really good to me. The only big concern I have are the margins. I wish we would see some improvements here since it is decreasing for a really long time now, so it is not only related to most recent events. From a dividend point of view, things look really good, with a really high dividend yield at a secure and safe level. On top of that, they pay a monthly dividend, which is also really nice. From a value point of view, I think things still look pretty attractive. When the stock was trading a little under $60, I decided to buy more shares. As of right now, I'm still thinking it is a good buy, but I'm waiting a little longer I think, hoping for lower prices. So basically I'm just waiting for a small dip and then start buying again. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.